Hi, and welcome to Brett's Corner, where we cover everything small business. From how to start a business, to how to grow your business, to how to keep your books, and ultimately how to position and sell your business, and some things to think about after you've sold your business. If you're a small business owner, or you're thinking of being a small business owner, you're in the right place. My name is Brett Hustleball, and I've been a small business owner for over half my career. I started my first small business in 1995. I quickly grew that one to over multi-millions in revenue, and I sold that to a Fortune 500 in 1998. I started my second small business in 2000. I grew that one more slowly to over $1 million in revenue, and I sold that to a multi-billion-dollar corporation in 2014. And now I'm retired. And what I like to do here at the Corner is to share the benefit of my experience with you. So, before we begin, a quick disclaimer. Number one, I'm not an attorney. I will share with you some of the experiences I've had regarding legal issues and what worked for me, but what worked for me may not work for you. If you have specific legal questions, consult an attorney. Number two, I'm not a CPA, nor am I a certified financial planner. But like every business owner, I know my financials, and we'll talk financials, and I'll share with you some of the things that you should know. But if you have specific financial questions or tax questions, consult a professional. Same goes with investment questions. Consult a professional. So, with that out of the way, let's get on to today's video. Hi. Today we're going to be talking about important financial terms that you as a small business owner should know. This is a continuation of a previous video where I began to cover some of these terms, and today we'll finish the rest of the terms. Let's start with chart of accounts. Your chart of accounts basically defines how you're going to keep your books, the various accounts into which you're going to track your financial transactions. Usually what I recommend is you get with your accountant at the front end of starting up your business and work with them to set up your initial chart of accounts. Now, most accounting packages that you buy will come with default chart of accounts, sometimes charts of accounts for various different business types, and you can pick one that matches your business type. But my recommendation is get with your accountant, have them help you set up your chart of accounts. The way I use my accountant, and typically have used accountants, is that I will keep my own books, but I will send my bookkeeping information over to my accountant on a periodic basis so they can do various filings for the state and for federal income tax purposes. So they handle my taxes, I keep my books. But in order for that to work properly, normally what we do is we agree on a chart of accounts up front. So that process works smoothly. So I recommend you get with your accountant and organize your chart of accounts with your accountant. So let's talk about accrual versus cash. Those are two ways you can keep your books. What's an accrual method of accounting? Well, usually you do accrual accounting if you are on terms with your customer or with your vendors. What does it mean to be on terms? Well, that means how you're going to get paid. So if, for instance, if you negotiate net 30, which used to be the industry standard with your customers, that means that when you invoice them, you won't get paid for 30 days, net 30. Now lately, I've seen big companies pressing that as far as they can. Net 45, net 60, I've seen as much as net 90. Now I don't know about you, but as a small business owner, 90 days without your money is an eternity. So always negotiate the best terms you can. So if you are on net terms with your customers, and then of course you would typically try to establish similar terms with your vendors, then you would use an accrual method of accounting. So why is that? That method actually accrues for those receivables that you have, the payables that you have, and you get credited with that receivables, and you get expensed with those payables. Even though you haven't written checks or received any money for those particular expense or payment categories yet, you get credited. So if you print out a profit and loss statement, which we'll talk about, you'll see as if you had already earned that money or if you already made those expenses. So that's an accrual method of accounting. Cash method of accounting is, as its name implies, it's instantaneous. When you deliver your goods or services, you get paid right then and there, point of sale. So usually you would use a cash accounting basis if you are a walk-in trade. Customers come in, they pay you right there at the point of sale, and you treat your vendors the same way. Then you might keep your books on a cash basis. Now you can keep your books one way, and you can present them another way to the IRS for tax purposes. The IRS will let you make that election once, I believe. What you can't do is you can't flip-flop back and forth. You can't say, okay, this year I'm going to be considered accrual basis because that's a better tax treatment for me this year. And the reason you might do that is for tax purposes. I myself keep my books on an accrual basis, and then I have my accountants submit my tax returns based on a cash basis. I made that election with the IRS, and that's how I'm treated for tax purposes. Had tax advantages for me. May or may not have advantages for you. Talk to your accountant. Let's talk about cash flow. Cash is king for a small business. It's the lifeblood of your business. Here's something important. You can be profitable and still go out of business. I'm going to say that again. You can be profitable and still go out of business. Why? Because you run out of cash. And if you run out of cash, your business could be in jeopardy. Let me tell you a story around that. Early on in my first business, I had negotiated a line of credit with my bank for $100,000. I had hired a very senior person to run my business as the COO. He was senior to me. And my largest customer came to me and said, would you go with us around the world and help us train our subsidiaries on how to use your process and your tools to do these large inventories? And of course I said, oh yeah, I'll do that. So before I left, we were zero on that line of credit. We hadn't borrowed anything. We had cash in the bank. Everything was good. So I left for 3 weeks. I came back 3 weeks later, and we were $100,000 extended on that line of credit. We had no cash in the bank, and we had payroll coming up. And by the way, if you're a business owner and you have employees, I guarantee you will eventually face the, oh my God, how am I going to make payroll? That was my first time facing that, and it almost cost me my company. So whose fault was that? Was that my COO's fault? He's the one that ran us out on that line of credit while I was gone. No, that was my fault. I took my eye off of cash. Never take your eye off of cash as a business owner. It is the lifeblood of your business. 3 weeks, that's all it took. We went from cash rich to almost out of business in 3 weeks. It can happen very fast. Never take your eye off cash. So what is cash flow? Cash flow is like your checkbook, right? You get a checking statement every month. It says, here's how much money came into the account over the month. Here are the checks you've written, how the money's gone out of your account over the month. Here's your beginning balance, here's your ending balance. That's a cash flow statement, very similar. Gets a little more complicated if you're on terms. Why? Because now you have to project when the money's going to come in based on the terms that you've negotiated, and when the money's going to go out based on the terms you've negotiated with your vendors, plus your payroll, maybe any other known expenses. You have to line all that up in time and see if you have any cash shortages. If you do, you better have a line of credit to cover those cash shortages. When I got bigger, I eventually hired somebody. That's all she did was manage my cash flow for me. She would do those projections. And then the biggest part of her job, where she spent most of her time, was calling customers. Because guess what big companies don't do? They don't pay you on time. Even to this day, they don't pay you on time. So you have to make yourself the squeaky wheel. You have to constantly be calling them saying, hey, I just want to make sure we're going to get paid when we're supposed to get paid. When's that check going to go? Has it been cut? Have you mailed it yet? So it's very important, still to this day, that you stay on top, to be proactive about getting your cash in the door. It's not just going to automatically come when you expect it to come. So that was a big part of her job. So cash flow, stay on top of cash. So let's talk about the rest of these financial statements. When someone asks to see your financials, what they want to see is your balance sheet and your profit and loss statement. So what are those? Let's talk about balance sheet. Your balance sheet is a snapshot. It's basically the net worth of your business. It's your assets equals your liabilities plus your equity, right? So if you know the equation for net worth, it's your assets minus your liabilities, right? That equals your net worth. Well, if you take the liabilities and add them into net worth, that equals your assets. That's the balance. Assets equals liabilities plus equity. That's your balance sheet. And there's some things you can see on a balance sheet. Financial people can read a balance sheet and do quick ratios in their heads, and I'll talk about one of those when we go to the examples. What's your profit and loss statement? Your profit and loss statement is over a period of time. It tells you basically whether you're making money or losing money. And so it shows by your chart of accounts all the various financial transactions, amounts that are in those accounts, and it sums up all of your income, sums up all of your expenses. Income minus your expenses will equal your net, your operating margin, and then subtract any taxes, add in any interest you've earned, and then you get to your net margin. That will also be visible on your profit and loss, also known as your income statement. So I've got examples of both the balance sheet and the profit and loss statement. So let's go to the computer for that. So here we're looking at a typical balance sheet. Now your balance sheet might look different, depends on your business, but this is typical. So first thing you see the assets, that's first thing listed, assets, and they're broken down. So guess what? The cash that the business has in the bank, that's an asset to the business. This particular business is on an accrual basis. They've got an accounts receivable. This is work that they've done. They've invoiced for this work, but they don't have yet the money in the bank. But that is considered an asset. The business owns that, is due that money, so that's considered an asset. Add all that up, you get all your assets. $226,000 here. All right. In addition to that, I'll take that back. You still have fixed assets. In addition, this business has fixed assets. You may too. You might have some vehicles. You might have some buildings. In this particular case, we've got computers, computer equipments. Those are assets. Assets, if they are fixed assets, will have a lifespan. And as over their life, they will continue to lose value. If you try to sell an asset tomorrow, it's going to be worth less than it was today usually. And those lifespans differ depending on the class of asset. And the lifespans are dictated usually by a thing called GAAP, generally accepted accounting principles. Your accountant will know what those lifespans are. The accounting software probably will know too. But over that period of time, for each of those types of assets, they will depreciate eventually down to zero. Depreciation is considered an expense. And so it'll show up on your profit and loss as well. But here, this is the accumulation of all depreciation forever. So here are all your assets minus all their depreciation and what your assets are worth today or as of the date of this balance sheet printout. Okay, you can see that these particular assets originally were about $72,000. They've lost $30,000 in value due to depreciation, and now they're worth about $43,000. Add all of that up, and now you have your total assets. Let's talk liabilities. You've got current liabilities. What are those? Current liabilities are liabilities, things you have to pay in the near term, usually within this accounting year. You can see accounts payable. Well, that's money you owe to your vendors. Probably within 30 days, maybe 30 to 60 days, that's going to be paid. You also have long-term liabilities. There aren't any on this balance sheet, but if you had SBA loans or any kind of bank loans that you're paying over a multi-year period, those would be considered long-term liabilities. Those are also part of your liabilities. Add up all of your liabilities, add in your equity, and that should equal your assets. Let's talk about some of the ratios. Let's talk about the equity. Look at that line called retained earnings. What retained earnings is every time at the end of accounting year, if you were profitable, and you had some money that you made, that will get added to your retained earnings account. That's your equity. Your books will then close, they'll reset, and they'll start accounting for the next year. And the one place that you'll look for any money that you've been accumulating over the years is in your retained earnings. That's your owner's equity. So a couple things about owner's equity. First, one of the ratios. If you're going to borrow money, one of the things that banks will look for is what they call debt to equity. They'll take your long-term, all of your liabilities, total liabilities, and divide that by your equity in the company, debt to equity, and they'll look at that, and that will tell them how leveraged you are, how much you've borrowed. And if in the days when I used to fund my business through debt-based financing by taking loans out, at that time banks would go no more than 2-to-1 debt to equity. So they look at my balance sheet, and about the time I sold my first business, I was right about 2-to-1. I was going to have to find some other source of capital. And so I was about as far as I could go on loans. In this particular case, we have a debt to equity. If you look at liabilities, $92,000. Equity, same thing, $92,000. We've got a 1-to-1 debt to equity. Probably fine to get a loan with this particular balance sheet if the banks are still going 2-to-1. Another thing to know about equity. That is the money that you've left in the business. That's your money. If you're the sole shareholder, if you're the owner, that's your money. So you can have two ways of paying yourself if you're the owner of the business. Number one, you can pay yourself out of that equity account. You can draw on that equity account, and that's called an owner's draw. And every time you do an owner's draw, that's not considered a payroll event. So therefore, you do not owe FICA and Medicare taxes on anything you draw out of that owner's equity account. And depending on your tax treatment, for instance, if you're subchapter S, you may not owe federal income tax because you may have already paid it. And so check with your accountant, but that is one way you can pay yourself. However, that could bite you. If you're not paying into Social Security, you may not be eligible, or it may hurt you when you go to file for Social Security at some point down the road when you retire. So check with your accountant, do your homework, do your math. Another thing to know that you can see on here is there in the liabilities, current liabilities, there's some money owed for tax purposes, withholding tax, FICA which is Social Security and Medicare. If you didn't know this, if you've been an employee and you've seen your paycheck stub, you see that you have withholding taken out, you have federal income tax taken out, you have FICA, Social Security, and Medicare taken out. What you may not know is that FICA and Social Security and Medicare that's being taken out, you're only paying half of that amount. The company pays the other half. So as a company now, you're going to pay the whole amount. And so what you're seeing here is the company's payment of those taxes, not the individual's payment. So that's one way you can pay yourself. The other way you pay yourself is as a standard employee. I've always been counseled by my accountant to pay myself as a standard employee. That's what I've always done. But you can draw off the owner's equity account. What happens if you draw too much? I've worked with one business owner who didn't know how all that worked. She just kept paying herself out of using owner's draws, and she drew that account negative. What happens if you draw that account negative? I mean, you could have cash in the business that you can be drawing on, but you've depleted your retained earnings account, your equity account. Well, at that time, as soon as that goes negative, you just took a loan out. Whether you knew it or not, you owe it back to the business. And if it's accounted for, it should usually be accounted for as either a loan to officer or a loan to shareholder. Let's talk about profit and loss statement. Here's a simple profit and loss statement. This is for a business that is just a one-man consultant. Okay, so in this case, we only have one income stream, consulting services. And after that, just a few expense categories, but they're typical: computer supplies, internet charges, insurance, salary. Salary is considered an expense to the business. There are those payroll taxes paid by the business again, telephone, travel, total expenses. Add up your total expenses, subtract that from your total income, and you have your operating margin. Here it's called net ordinary income, but that is your operating margin. Below that, you add in any interest you may have earned in the bank. In this case, we've earned some interest, $8, and subtract any taxes you may have had to pay, and then it will come up with your net income. And we've talked about net profit margin, net margin. So that's a profit and loss statement. So let's recap. Today's video, we've talked about chart of accounts. Those are basically the various accounts into which you'll track your financial transactions. That's how you will keep your books. We've talked about whether you should be on an accrual basis or a cash basis. If you've got terms extended to you or you extend terms to your vendors, you probably want to be on an accrual basis. Otherwise, if you walk in trade and everything's instantaneous, you can be on a cash basis. We've talked about cash flow and the fact that you can be profitable and still go out of business. Never, ever take your eye off your cash position. Know your cash flow statement at all times. Very important. We've also talked about your financial statements, the things that people call financials. They say, I want to see your financials, they want to see your balance sheet, and they want to see your profit and loss statement. Your balance sheet is a snapshot in time. It's basically the net worth of your business. And your profit and loss basically telling you whether you're profitable or not over any given period of time. If you like the content we're providing here, please follow us. And as always, if you have any questions, please direct those questions to info@brettscorner.com. I'll watch that email address and I'll respond to your emails. I won't respond to comments you leave on the video, so please use the email address if you have any questions or you want me to respond. And as always, thanks for watching.